Hello, my name is Greg Michalowski from ForexLive.com. I want to welcome you to the Weekend Forex Technical Report for the week starting August 15th. In this video, I will outline some key technical levels, some key biases, some key risks, some key targets, those things from a technical perspective. But before I get into that, I also like to talk a little bit about the fundamentals. So sit back, relax, and enjoy. Before I get into the report in the nitty-gritty of the technicals that I'll be watching this week and what the market is telling me from that perspective, I wanted to give a little bit of overview about why I do this, what you can get from it, what you can get from my videos during the week, and some of the little nuances that I hope that you can learn and follow and apply in your trading analysis. First of all, there are plenty of ways for traders to analyze the market. But one of the key points that I always look for in someone's analysis is, are they focusing on risk? And that is my number one priority when I post something on ForexLive.com or I do a video. It is to focus on risk. In every trade that you do, you should define your risk, you should limit your risk, and then the third step is to accept your risk. That's the step where you actually push the button to trade, is because you did your homework, you understand your risk, you limited your risk, and now you're ready to trade. That's the basis of the foundation of all successful traders. I don't care if you're the newest trader or you're the most experienced trader, both of those extremes should follow, understand and follow risk. And that goes not only for trading, it goes for everything in your life. Including finding your spouse, when you get in the car to drive, any other decision that you make in life, you're focused on defining risk, limiting risk, and accepting your risk. There are just different degrees that you apply to it, but trading, you have to be focused on those, on the specifics of defining and limiting risk. So if you watch my video, if you see any of my posts, I'll always talk about risk. I then also look for levels where you can define and limit risk. That may come on a shorter term chart, what happened in London, for instance, or it may come off a longer term chart. And I want you in this video to focus on those aspects of where I define risk and why I define risk. I use tools that will help me define that risk. And why do I use tools? Because I feel like traders around the globe or the market will look at tools, technical tools, to define and limit their risk. They become borderlines or levels that you can lean against, a word that I often use in my posts, in my videos, that you can lean against to define risk and limit risk. If the price stays above, it's more bullish. If the price goes below, it's more bearish. You'll see these patterns in all my posts and all my videos, and that is what I want you to focus on as well. And then from that point, you then start to look at targets. Where are we going, and why are we going there? And again, those targets, those levels, give you confidence that the trade is right, that the trade is doing what you think it should do, and that the market, the buyers and sellers, are on board with you, because they are the ones that are going to help push the price to the levels that you want to get through. So I always think that you want to trade with the crowds, that you want to be in that herd that is going this way as opposed to that way. However, when you get to certain levels down the road, you may look to turn that crowd around. Think of it as a farmer, a sheep farmer moving his herd from one pasture to another. You want to move them all in direction, and then you get to the pasture, and then you want to move them in a different direction. That may be sideways in the pasture or whatever. That's the idea that I'm trying to portray in my posts as well, as you have targets, but those targets may reach its destination and get to the pasture. You get what I'm saying? That's all I want to talk about right now, but I hope that you have this basis to going forward and that you get more out of my videos going forward as a result, and you follow them each and every day. So before I get into the technicals, I also want to talk a little bit about what happened in the market this week. And a week ago, we sat here and we talked about 528,000 new jobs created. This week, I'm going to talk about the inflation numbers, because we had CPI inflation, we had PPI inflation, we also had a thing called import price inflation or deflation, as it was this week. So let's talk a little bit about that. This week was about inflation, and the worries about inflation were sort of eased this week. We had CPI come in, and it was released and showed a 0.0% gain versus a 0.2% expected for the headline number. The core came in at plus 0.3 versus 0.5, weaker than expectations. Year on year for the headline moved down from 9.1% to 8.5%, and the core measure stayed steady at 5.9%. So CPI got the markets moving, got the dollar moving a little bit lower, got stock markets up, heated up, so interest rates sort of moved to the downside as well. Then we got PPI inflation as well this week, and PPI inflation also showed lower levels. The PPI final demand fell by minus 0.5% versus 0.2% estimate. We saw the ex-food and energy rise by 0.2% versus 0.4%, and the year-on-year level for the headlines plunged to 9.8% from 11.3%. The ex-food and energy also fell sharply to 7.6% from 8.2%. Now, the direction is right, but the levels of those measures are still very high, and that has the Fed going to continue to tighten. But the hope is that there is a trend where inflation numbers have started to peak and may even start to come down or stay unchanged. Remember, a year-on-year number is made up of 12 different months. And so if you start to get 0%, 0.2%, minus 0.5% here and there, it's going to replace a higher number from a year ago with a lower number now. And so you start to take chunks out of the inflation year on year. It still takes a while to get through that 12 months of increases, but it's moving in the right direction. Now, do I think that may continue down the road? Well, the 528,000 jobs created, those people are working, and they may still force up the prices because they're working, okay? And they're making a paycheck, and they still are out buying. I don't know if they're going to start to scale back, start to lower prices. We see demand start to move back to the downside. We see inventory start to rebuild, shifting from more back into the services, or services back into goods. I don't know. I don't know what's going to happen. But what I do know is that we got better inflation data this week. We still have the employment situation, which is very strong, which is good news. And we still have a Fed that's intent on raising rates going forward, because they have this ability to raise rates when employment's moving higher and inflation may be starting to move lower. So that's good news for the Fed. They like that, but they want to make sure that inflation does not pick up anymore. So with that all said, let's start to take a look at the technicals, because ultimately the technicals will help tell your trading story, because it will define the risk. It'll allow you to limit risk. It'll also give you a bias whether it's bullish or bearish. So I'm going to start off by taking a look at the euro versus US dollar, and I'm going to start by looking at the daily chart. And if we look at the daily chart, we had lows right here, we had a low right here, we had a low right here, and then we broke below this floor area. Not shown, but if you go back to 2020, there was another low which came within this area. I think it was at 103.395 to be exact. And that helped define this yellow area, or this swing area through here. And the price moved sharply to the downside, fell below the parity level, and then has been rebounding over the last month or so of trading. On On Wednesday of this week, the price moved up to test the upper end of that extreme, and we needed to get above that level to increase the bullish bias. Not only was the swing level there, but the 50% retracement of this move to the downside here was also at that level, a technical tool that I like to use, that other traders like to use as well, the crowds. And the price started to find some sellers against that level, and we moved down, closed up on the day, but down here on Thursday we moved back up to that level and retested the upper extreme. And what did we do? The sellers leaned against the level once again because risk could be defined, risk could be limited, and the price moved back to the downside. On Friday, we saw a continuation to the downside here as the fundamental story, shifted from the inflation to maybe problems in Europe. We had Germany, which had the Rhine River go below critical levels for navigation of that river by ships, and that had an impact on the price of the euro. The price started to move lower, and we moved away from our technical extreme. I could also say that sellers or buyers through here turned to sellers. Why? Because they couldn't get above the 50% retracement level. It can be as simple as that. But from a technical perspective, that level held resistance. The price started to move back to the downside. If we take a look at the hourly chart, we can get another view of the market. And as we see off of the Wednesday and Thursday's high, the price did move up to the upside, and then we came back down into this area right through here. This area was the high of the up and down trading range that confined the pair for about 18 trading days until the break to the upside. And we came back down into that yellow area through here, this swing area up here at the highs, and we found support buyers near the old swing high here, the old swing high here, and we saw the bounce back to the upside. When we couldn't get above the 50%, above those levels on the daily chart, the price started to move back down, and on Friday we fell below the upper extremes here into the the big heavy part of this box through here, and we started to see more selling below the 100-hour moving average. Going into the new trading week in the short term, the 100-hour moving average will be a resistance level and a risk defining level or a bias defining level for the traders. If the price can move back above, we're going to have this swing area here reestablished as resistance. We need to get above that level to increase the bullish bias. Alternatively, if the price stays below this level, we could see ourselves returning back to the 200-hour moving average, where if we move below that 200-hour moving average, it would increase the bearish bias on the downside, and we could ultimately see the price move all the way back down to our lower extremes here, the lower extremes of this box through here. So that's the technical view. We are more in a neutral area in the short term, below the 100, above the 200-hour moving average, but we're looking for the shoves either to the upside and above this topside risk level, or below the 200-hour moving average, which should increase the bearish bias. Let's take a look at the dollar versus yen. And if we look at the dollar versus yen on the daily chart, we see this swing area similar to the view that we saw on the daily chart. We had a swing high, break above the swing high, come down, retest that swing level, and then move higher. In trading last week, or actually earlier, I guess it was last week, the price did move below this swing area and came down and tested our 100-day moving average and bounced back higher on this day, and then forced our way back up to another swing area here. We had a swing high, swing low right here, and we moved up to retest that area ahead of the extremes through here, and the price rotated to the downside in trading this week. Our low price this week held ahead of this swing area between the 131.24 and 131.48 level, and ahead of the rising 100-day moving average, which is now in between those levels. And we bounced higher on Friday with the dollar buying that we saw. We're currently trading at 133.47, sort of in between this high and this low right here, where we have resistance and support there. So we're sort of in a neutral area where the market is battling back and forth between the buyers and the sellers. Let's take a look at the hourly chart and see what clues we have from that. And if we look at the hourly chart, The move to the downside on Wednesday did get below a swing area here that we not necessarily could have seen on the daily charts, and the importance of looking at the hourly. We had a low here, we had a high here, we had a low here, we had a high, another low here. We broke below the level and failed. We tried to hold support here and failed, and then we rotated to the top side. So this swing area is a level that I'm going to continue to watch as a barometer on the downside. If we move below it, then I think we make a run toward the rising 100-day moving average on the downside at 130, 134. This was a test back in early August where the price did find support not once but twice ahead of that 100-day moving average. Risk to be defined and limited, and the price moved higher. Now, on the top side, what do we have here? We have the 100 and 200-hour moving averages converged near the 38.2% retracement of this move to the downside. So we have 1, 2, 3 technical levels in play at 133.82. That level is going to be a key barometer in the short term. If we're able to get above that level, that would increase the bullish bias. I would look for higher levels from a technical perspective. The buyers would be making a play to the upside. If we stay below it like we did on Friday, then the sellers remain in control. Okay, the sellers leaned against this level and said, nope, ain't gonna go there. Dollar yen's going lower, and they pushed it a little bit lower. So if you have a bias from a fundamental perspective, and that bias is to buy the dollar, maybe sell the yen, what you want to see is a move above these levels right here and then stay above those levels. Alternatively, you may look to buy against this swing level and hope that it doesn't go down further. But if it does go break this level, break the 100, you don't want to be in the market, no matter what your fundamental bias. Okay, you want to wait for the price to start to get back above these levels. Now, if you are want to be long the pair, you definitely want to see the price move above these levels and start to take out the prior highs through here that we saw in last week's trading. So that's the decisions that you have to make, and those are the technical levels that are in play for that currency pair. Let's take a look at the sterling versus US dollar. Again, I'll start on the daily chart here, and what we can see in this currency pair is that at least from a technical perspective, is that the price high for the August came in short of the 61.8 of this last move to the downside. We got above the 50%. We found sellers against the 61, and then we started to reestablish the 50% as resistance. In trading this week on Wednesday, we saw the price move higher, but we could not extend above the prior high through here, and we saw a rotation back to the downside here over the last two trading days in the sterling versus US dollar. If I were to make a trading decision off of this pair, I like the 50% retracement as resistance. We sort of held that level on Friday and came back down off of that level. If we get back above it, although the price tried on two occasions this week and failed on 2 occasions, getting above that level and staying above that level would be a step more in the short-term bullish position off the daily chart. There would still be work to do. The 61.8%, the falling 100-day moving average, this swing area right here would all be targets to get to and through, but those would be getting above the 50% of just this move right here is a step in the bullish direction. If we can't get above that 50% level, though, the sellers still remain in control. The bias is still in their direction. I give them all. In fact, they currently have the bias is definitely to the downside for this pair from a technical perspective. You could also see that on the hourly chart. And why? Because similar to what we saw in the dollar versus yen, the 100 and 200 hour moving average are providing some pretty decent resistance right through here. It also happens to correspond with the 61.8% of the trading range that we saw last week. So we're finding some sellers against the 100, 200 hour moving average. So is this showing a more bearish bias here for the sterling versus US dollar? Sure, it's showing sellers are willing to lean against that level, albeit so small. But as long as the price remains below that level, the bears remain more in control. If they were to move above that level, then we can start to talk about getting above the 50% level at 122.12 up here, okay, around this area right here. We can stay above those levels. We can talk about getting up to this level and start to take out the prior highs through here. Absent a move above that level, Who's in control? The sellers are in control. We start to look down toward the 120.63 level where we had swing low, swing low, swing low, swing low, swing low, swing low, swing low. All those levels would need to be broken on the downside to give the sellers more comfort, and then we start to look toward our low price that we saw not in the prior week, but in the week before last, at near the 120 level. Nice round number there for the sterling versus US dollar. Let's take a look at the dollar versus Swiss on the daily chart once again, and what we see here from a technical perspective is the price moved below the 200-day moving average. That's the green line in this chart, and the price moved below those levels, sort of moved into this swing area where we have a number of, again, swing lows and highs, or actually mostly swing highs through here, where the price came in between 0.9342 and 0.9382. And so it came in between those levels at 0.93656, and the price rotated back to the upside. We're trading just below the 100-day moving average going into the weekend. We're also just below the 50% retracement, or right at it, really, of the range since really the range for the year. Okay, this is the 50% of the range for the year, so we're right at the midpoint of the year's trading range, which is sort of a neutral level, sort of near the 200-day moving average. So if we were to just look at this chart from a daily perspective, we are sitting on the fence waiting to get shoved over on this side or shoved over on that side, and that's what the decision is going to be made this week in trading, whether we go higher or lower here on the daily chart. Below on the downside, we also tried to hold, or we found support buyers within this swing area, and also ahead of the upward sloping trend line. So if on the downside, if we start to break further away to the downside, get below this trend line, get below the swing area, the bears are in control. Alternatively, move above the 200-day moving average, and we see higher prices in the dollar versus Swiss. Let's take a look at the dollar versus Canada next. And on the daily chart, what did we notice here? We see the 100-day and the 200-day moving average, for the most part, confining the trading range on both Thursday and Friday. Admittedly, there was a break to the downside that failed, and a little break to the upside that failed as well. But the price is trading in between those levels, also near the 50% of the move up from the, I guess this is the October low to the high here. So a lot of key technical levels right here, which suggests the pair is sort of in a neutral area, looking for that shove one way or the other, either above the 100-day moving average or below the 200-day moving average. Unlike the dollar Swiss, where it just stayed on the daily chart, I want to take a look at the hourly chart just to show you what the price action was like outside of the moving average, the daily moving average extremes. And on the downside here, the sellers had their shot. Okay, they had their shot here, here, and again here. But our low price through here was shorter than the lower prices from Thursday's trade, and that helped to move the price back up to the upside. On the top side, Friday afternoon liquidity, maybe coming into the London close, the price did move above the 100-day moving average, only to fall back below it and use that level as resistance. We're trading in between those two extremes and need to get above or below those levels to increase the bullish or bearish bias. Right now, the buyers and sellers are battling it out in between those two levels. Let's take a look at the Aussie versus US dollar next. And again, on the daily chart, where do we sit? We sit in between the 100-day moving average below, 200-day moving average above. We need to get above the 200-day moving average and the 50% of this range to the downside here to increase the bullish bias. On the downside, we have this swing area through here, also with the 100-day moving average. On Friday, where did support hold? Against the 100-day moving average. So the buyers are trying to make a play to the upside, but they have work to do to get above the 200-day and the 50% retracement. If they're able to do that and stay above that level, that would increase the bullish bias. Alternatively, if they're not able to get above that or get to that level, and the market moves below this 100 and swing area, the bias would be to the downside. And we can start to look toward other swing areas like the 69.66, 69.93. Let's call it the 70 level on the top side as a key level to get to and through if the bears are to take more control. Finally, take a look at the New Zealand versus US dollar. This week, the Reserve Bank of New Zealand will are expected to raise their rates by 50 basis points, continuing their tightening. So understand that fundamental. By the way, I think in Australia they have employment data coming out this week, so that's going to be key as well for the directional bias for that currency. But what we know in the New Zealand versus US dollar is that it moved back to its 100-day moving average, 38.2% retracement ahead of this interest rate decision this week. Again, this will be the bias either to the upside or downside. The barometer, which way are we going to go, is going to be dependent upon what happens right here against this level. Traders can lean against it, hope for a move one way or the other, understand the risks through the data, and try to manage that risk. You can manage it by not trading and then trading after if there's a surprise or a definitive move, but watch those levels in the watch the 100-day moving average 38.2 as the bias for this week. Off of the hourly chart, the rising 100-hour moving average, the market moved away from that in trading this week after consolidating around both the 100 and 200-hour moving average. When they started to move away from that level and move above the broken trend line, above this old swing high, above this old swing high as well, we saw the momentum extend to the upside. The price was breaking out and it took the price higher. We took the price higher, but we're running into resistance and consolidation around the 100-day moving average as it prepares for that big event this week in New Zealand. So there you have it, a look at some of the major currency pairs. If I were to take a quick look at the stock market, just for giggles. All right, this is the daily chart of the NASDAQ index. And if we take a look at the NASDAQ index is now over 20% above its low. So we're actually in a bull market, but we're still some 16 or 17% away from its high that we saw in November as well. So there is a bullish market here, but we're still way well below the highs that we saw last year. This area between 13086 and 13199 is the next target to get to and through. We still need to get through the 50% retracement for more bullish bias, and also the 200-day moving average, 50%, 1338.68, 200-day moving average of 13509.55. This swing area tops out at 13199. Let's call it 13200 to get above that level. So those are the targets on the upside for further momentum. The NASDAQ has been up 4 consecutive weeks. On the downside, if we move back below the 38.2% retracement, that was a swing high through here. We moved above it here and then broke back below it, but then reestablished support at the 38.2. Getting below 12722.32 would be a disappointment in the move to the upside and could lead to more corrective pressure down toward our 100-day moving average at 12291.69. Let's take a look at the S&P index. This is getting closer to its 200-day moving average. It moved above and closed above its 50% retracement on Friday. That's more bullish. Now we have the 200-day moving average to contend with on the top side. If we move above that, that would be more bullish. And finally, the Dow Industrial Average, it too moved above its 50% retracement of the move down and is trading above that level at 33302.97. But it is also moving up toward its key 200-day moving average above at 1390.04. Get above that level would be needed to increase the bullish bias for the Dow Industrial Average. So there you have it, folks. A lot of everything here in the weekend report. I hope that you picked up some of the nuances of my analysis, have a better idea for it. Please go to my daily videos and look at that and make yourself a better trader. My job is to get you to the point where you can do this yourself so that you understand what you're trying to do, where the risks are, most importantly, where your targets are, and learn about defining risk, limiting risk, and accepting a risk so you become a better trader. My name is Greg Michalowski. Good fortune with your trading. Talk to you on Monday. Bye-bye.